Did you know that you could help build your child's credit history so that they can have an 800 plus credit score by the time they head up to college? Did you also know that you could pay for your child's preschool or daycare first from your paycheck before the tax man takes his cut? In this video, I hope to offer a roadmap to help you efficiently navigate the financial aspects of parenthood derived from the methods I use myself for my own family. Hi, if you're new to the channel, my name is Dr. Dang, the financial neurologist. I'm a board-certified physician turned financial nerd, and together we'll take a look at how your brain influences your personal finance. Let's get started. Smart money move number 1, build your child's credit early. Did you know you could add your child as an authorized user on your credit card? There's no age limit and this is completely free. Doing this will help them build their credit history even as a newborn. By starting early, your child has the opportunity to establish a positive credit history, and a longer credit history generally contributes to a higher credit score. Scores of 800 or above is only obtainable with a long credit history. A good credit score can lead to lower interest rates when applying for loans or credit cards in the future. This can result in substantial savings over time, especially for major purchases like a car or a home. As your child grows into adulthood, having an established credit history can facilitate financial independence, making it easier for them to rent an apartment or obtain a loan without needing a cosigner. Smart money move number 2, protect your child from identity theft. Did you know that you could request a credit freeze for your children as well as yourself? Thanks to a new federal law that was passed in 2018, the major credit reporting bureaus are required to initiate a credit freeze for children under the age of 16 upon request, and they are supposed to do this for free. I've done this myself. It requires little more than sending in a letter to each of the major credit reporting agencies along with some proof, and they should respond within a few weeks confirming that this has been completed. Children are often attractive targets for identity thieves because not only do they have a clean slate, they never check their credit history, which makes sense. Why would a 2-year-old check their credit? So often, acts of identity theft go undetected for years. Identity theft can have severe and long-lasting consequences for a child. If a child's identity is stolen, it can affect their ability to pursue higher education. For instance, false records of debt under their name might hinder their chances of getting student loans or scholarships. In summary, protecting your child from identity theft is essential to safeguard their financial future, their educational opportunities, and their emotional well-being. Implementing proactive measures now to secure their personal information helps ensure a smooth path forward as they navigate the complexities of adulthood. Smart money move number 3, the better way to pay for preschool and daycare. Did you know that you could pay for your child's daycare, preschool, summer day camp, nanny services, and much more from your paycheck first before the taxman takes out his cut? This is what happens when you utilize a Dependent Care Flexible Spending Account, or FSA. A Dependent Care FSA allows you to use pre-tax dollars to pay for eligible expenses for children under the age of 13. Contributions to a Dependent Care FSA are deducted automatically from your paycheck, and accessing these contributions is as simple as submitting your receipt and getting a direct deposit a few weeks later. Contribution limits change every year, so I would check the current tax laws. But for 2023, I've contributed $5,000 to my Dependent Care FSA, and it has effectively allowed me to pay for my child's preschool with the equivalent of $8,000 in post-tax dollars. Smart money move number 4, use tax-free growth for college. Did you know that you can invest money into an account that grows essentially tax-free and allows for also tax-free withdrawals for qualified education expenses? This is a 529 college savings plan, which are state-sponsored plans essentially geared to help parents pay for their child's higher education. Did you also know that you aren't limited to choosing just a plan sponsored by your state? You can choose from any of the state-sponsored plans. In addition, you can open up one directly with your brokerage company, such as Vanguard or Fidelity. Contributions to a 529 account are made with after-tax dollars, and many states offer tax deductions or credits for contributions, providing immediate tax benefits. Qualified withdrawals from a 529 account, including tuition, room and board, books, and other educational expenses, are tax-free at the federal level, and some states also offer tax benefits for qualified withdrawals. If the intended beneficiary of the 529 account decides not to pursue higher education or receive scholarship, the account owner can change the beneficiary to another family member themselves, or even convert a portion of that amount to a Roth IRA without penalty. Contributions to a 529 plan are considered gifts for tax purposes, and under current tax laws, individuals Individuals can contribute up to $17,000 per person or $34,000 per married couple per year without eating into their lifetime gift tax exclusion of $12.92 million as of 2023. In effect, unless you are super rich, your friends and family can contribute to your child's 529 account without effectively worrying about being taxed. Set the stage now to ensure that their future education is not hindered by financial constraints. Smart money move number 5. Open a custodial Roth IRA. Time is a powerful ally in investing. By opening a custodial Roth IRA early, your child benefits from the potential for decades of compound growth as the earnings generated within grow tax-free over this time. Roth IRAs have no age restrictions for contributions as long as your child has reasonable earned income, which could come from mowing the lawn or doing other household chores. In addition, a custodial Roth IRA can serve as an educational tool, introducing your child to the concepts of investing, saving, and long-term financial planning. Involving them in the process early can help build valuable financial literacy skills. Smart money move number 6. Get term life insurance. Life is unpredictable, but providing for your family financially doesn't have to be. Now, when we start thinking about life insurance, I'm not talking about whole life insurance. That stuff is garbage for a myriad of reasons we won't go into here. I'm talking about term life insurance. You might be surprised at how affordable term life insurance could be. Often for less than $100 per month, you could cover your family for $1 million or more, depending on your age and health. That way, in the tragic event that you won't be there to take care of them, it would help ensure your family can still cover living expenses, satisfy any remaining debts, as well as funeral costs long after you're gone. Smart money move number 7. Get long-term disability insurance. What is that analogy? Always put the oxygen mask on yourself first. This is that scenario. You cannot do any of the things previously mentioned if you lose your primary source of income in the event of disability without a backup plan. Unlike short-term disability insurance, long-term disability insurance is designed to provide you with years of income, often into retirement age in the event of a severe, prolonged disability. Having this can give you the peace of mind that comes with knowing that your financial plans are on track and that you can continue to maintain your current standard of living as well as cover essential expenses such as mortgage payments, utilities, and daily living costs. Though more expensive than a term life policy, it is one of the essential table legs of your financial plan. Smart money move number 8. Set your beneficiaries and create a will. Aside from life insurance, there are other ways in which you can make sure your family is taken care of financially in case something tragically happens to yourself or your spouse. This could be as simple as setting the beneficiaries on your life insurance and financial accounts, setting up a revocable transfer and death deed for real estate assets, to hiring a lawyer and drafting a last will and testament. It's important to establish clear directives to make sure that your assets are distributed according to your wishes and your children are in the care of those you trust. There are lots of DIY methods that do not involve a lawyer for asset distribution, but if you need more complex estate planning, it is probably better to involve one. Smart money move number 9. Build an emergency fund and prioritize debt management. Look, parenthood is hard enough, and life is full of surprises. Not all of them are pleasant. Whether it's a sudden medical expense, car repair, or home maintenance, having an emergency fund ensures that you can handle these unexpected costs without derailing your family's financial stability. Without an emergency fund, people often turn to credit cards or loans to cover unexpected expenses. Building an emergency fund helps you avoid accumulating high-interest debt. Furthermore, a lower level of debt contributes to increased financial stability. It reduces the risk of financial hardship if unexpected job loss or expenses arise, providing a more solid financial foundation for your family. And on to the final point, I strongly believe that the best way to ensure your children's future is in laying the foundation for financial literacy. Smart money move number 10. Teach smart money habits. There's a difference between telling your children how to do something versus showing them. The psychology of money is powerful. Children often learn by observing their parents or guardians. The money habits that you demonstrate today would be a powerful framework that might shape how they view and approach personal finance for the rest of their lives. Do you spend impulsively on things you cannot afford, hold onto a credit card balance, and avoid paying off debt? Or do you plan carefully and make purchases intentionally? Emphasize the concept of delayed gratification by encouraging kids to save for something they want instead of buying impulsively. Better yet, discuss the differences between needs and wants and help them prioritize their spending based on their values and goals. This helps instill patience and a sense of the value of money. As children get older, involve them in discussions about more complex financial topics such as budgeting for family vacations, saving for college, or making larger purchases. This helps them develop a broader understanding of financial decision making. Also, teach the importance of giving back by involving kids in charity charitable activities, whether it's donating a portion of their allowance or volunteering time. Instilling a sense of social responsibility is an important aspect of financial education. Remember to tailor your approach based on the age and maturity level of your child. Consistency, patience, and positive reinforcement are key elements in successfully imparting smart money habits to children. If you found value in these videos and want more useful financial insights, hit that subscribe button, tap the notification bell, and be a part of our journey. Stay tuned and keep thriving.